All right, let's get started today. Welcome, everyone. Thank you for joining us for our Vance Wealth Advanced Perspective monthly webinar. We did a last-minute audible and decided to cover a topic that's been all over the media over the last 3 weeks and probably will continue to be for the next few months. So we titled our presentation today, Managing Money in Times of Economic Uncertainty. And so I'm really happy to be joined by Chris Pelch, who is our Chief Operating Officer and our Chief Compliance Officer. So welcome, Chris.
Thanks, John. Looking forward to it.
Absolutely. So I know this topic has been something that I've been having a lot of casual conversations or just with friends, family, because this is something that's making the nightly news. You know, a lot of times our world doesn't really make the nightly news when things are quiet. Obviously, when there's stuff going on in the world that I would say impacts the average person, then it becomes more of a household topic and household conversation. So today we're going to go through and I think dispel a few myths and really just try to share our perspective on what's happening. Let me make sure I can advance here. So one of the things, this is what we're going to go through. So this topic today is going to be strictly designed to talk about what's been going on with the recent bank failures. Really, how did this happen? How did we get here? What did the government do? Was it necessary? Was this a bailout? We're also going to give you, Chris is going to provide thoughts on how the FDIC works, as well as SIPC coverage, which I think a lot of investors aren't really familiar with SIPC. And then we're going to really end with what can investors do now? So that's really going to be our focus for today. Additionally, I know we have a fair amount of attendees. If you're joining live, feel free to ask questions. So there's a Q&A button. Go ahead and pose questions, and we'll do our best to answer these in real time. If we get to some topics that are really unique and individualized, then what we'll do is we'll take that information down and we'll get back to you in the next few days with a more specific answer. And so without further ado, let's just jump right in. So when we look at the bank failures / bailouts and really try to address the question, how did this happen? You can see we've put some logos up here. And so for each of these banks that over the last 3 weeks have been dealing with these headlines, Silicon Valley Bank and Signature Bank were the two big ones. Silicon Valley Bank, Silvergate, and Signature were all bailed out basically by the FDIC several weeks back. And then Credit Suisse and First Republic, those have been two financial institutions that have been in the press over the last week and will likely continue to be, because in different ways, the financial services area and the government is trying to figure out what to do because a lot of these two banks in particular, they are stressed at this moment. And so, we want to address like what really happened and give you some perspective. Unfortunately, the reality is, especially in the world we live in, we're getting a lot of, I would say, a lot of political rhetoric, and I think that's normal. But I do think that there was some good that came out of this and some what I would call necessities, but there are also some probably unintended consequences that might have some challenges to the overall health of the economy. And so today we're just going to kind of really run through the basics of how did this happen and where do we go from here. So essentially what started this is that we had a rapid rise in interest rates. So interest rates over the past year shot through the roof. So if you look at this chart, this goes back to about 2006 all the way through current day. And this just shows where the federal funds interest rates were over the past, I guess that's about 15 years. And you can see when the financial crisis hit, back in 2007, you can see there's a shaded recession as well as a decline in interest rates, which is what the blue line represents. The Fed actually cut interest rates sharply to really try to really shore up our economy. We all went through this Great Recession environment, and interest rates stayed flat and almost at zero for a prolonged period of time, from about 2008 all the way through about 2015. Then interest rates started to go back up as the economy started to recover. And then you can see about 2020 when COVID hit, interest rates went back down to zero. We had all the stimulus. And so coming out of COVID, we had a fair amount of inflation that started to show up in the system. And so the Federal Reserve has been pretty adamant about we need to control inflation, so we got to raise rates. And that's what we've been living through. And so in 2022, we saw basically a massive spike in interest rates. And this had some now in hindsight, some pretty devastating effects on these banks. So the reality is, and we're going to go through a little bit of like how do what does this actually mean for us as investors and for the banks. So the chart that I have here, it basically represents performance of the U.S. Treasury or U.S. Treasury bond market, and looking at different maturity types: 2-year bonds, 5-year bonds, 10-year bonds, and 30-year bonds. And I wanted to give you a little bit of history, but the long and short of this is that we had the worst year in over 100 years in the bond market. And that's pretty rare, obviously, to have over the last 100 years. This last year was the worst year that we've seen. And it was primarily due to interest rates being so low and then spiking to these higher levels. And if you see on this chart, you can see as an example, the 2-year Treasury a year ago, as of the end of 2021, the interest rate was at 0.73. By the end of last year, we were at 4.41%. So because of that big jump in interest rates, it resulted in a loss. And one of the things, if we just go back to our traditional our understanding of the economic cycle of how a bond works, is when interest rates go up, bond values go down. And so that's what you're seeing here. So on the far right, it shows the 2022 total return for the different types of bonds. And you can see the 2-year lost 4%, the 5-year lost almost 10%, the 10-year bond lost almost 16%, and the 30-year bond lost over 33%. So this is what kind of kicked off some of the challenges we're seeing now. There's other things that led to this, but this is really what started the challenges for the banks. And so this is just a chart from the FDIC. And the things that we're looking at here is there's a dark blue, which is known as, these are assets that are known as held to maturity. So what that means is that if I buy a bond and my goal is to hold it until it matures, the price is going to fluctuate throughout the time that I own it. But really, I'm going to just own it. So I don't really care that the price is going to go up and down, but because once the bond matures, I'm going to get back my initial investment. Then they have another bucket, which is, this is kind of it's like a gold color. These are securities that these banks have on their balance sheets that are available for sale. So if you as a depositor want some of your money back, the banks can go liquidate assets and they can go sell basically securities that were available for sale. And so what we're looking at is this time frame is very similar to that interest rate chart that I showed you, and it shows the impact of you can see that zero line. Basically, that zero line shows that you have an unrealized gain when the bars are above that line, and you have an unrealized loss when the bars are below the line. And so if you can see all the way over here, I don't have a pointer, but you can see, I guess it's a little, can you see that, Chris?
Yeah.
My little pointer over here. So what this shows you is that in 2022, due to the spike in interest rates, you can see what happened is look at the size of these losses. We had not seen anything like that over the last 15 years. And that's because we saw interest rates at such low levels for such a long period of time. But the reality is this hit, and banks had these losses on their balance sheets. Now, most of these in the blue were not repriced, which means I guess Wall Street didn't know. It's hard for me to believe that the federal government and FDIC didn't know, but this is what led to a lot of the challenges, which got us to today, or let's call it got us to 3 weeks ago when we had what I would call a run on the bank.
And John, I think it's also important to kind of note, most of these banks, I mean, their investments, what's held in their bank account, right, or their investment accounts, these are safe securities, right? And I think what you just showed on the previous slide, these are investments in U.S. Treasuries, so they're backed by the U.S. government. That's typically considered to be a risk-free asset class. So this isn't investments failing, they're making irresponsible investments, but they were just really long out on the yield curve, and so they were getting some of these really safe investments had a lot of price depreciation because of the simple nature of how interest rates move. So I think it's just really interesting to see that that's kind of throws a wrench in that whole idea of safe investing by being an investor in the U.S. bond market, and that just didn't play itself out, and clearly you can see how that resulted for the balance sheets of some of these firms.
Yeah, and then, Chris, just going back to that, because I think that's a great point. The reality is when we look at, what happens is if you deposit money at a bank, and they, as we know, a year ago, they didn't have to pay you a lot on your deposits. They almost were paying you nothing. So the bank said, okay, we have all this money. What are we going to do with it? Let's go buy some assets that we can get a yield on. So what happened is, last year, a 2%, or sorry, a 2-year treasury was only yielding 0.7 and a 10-year was 1.5. So, these banks took some of this additional, what they call duration risk, which means they bought these longer term bonds. Well, by doing that in the short term, they got higher yield, but because of bond price movements, this resulted in a lot larger loss. And so, Chris, that's a great point around the banks weren't trying to take undue risk. They were buying assets that they thought were going to be more stable. And because they're these held to maturity assets, they thought they would be fine. But the reality is this is, we hadn't seen this kind of a bond move in 100 years. And unfortunately, banks were not prepared for that. So, when we look at well, why were these banks impacted, right? Why aren't we seeing headlines with Bank of America or Wells Fargo or Chase or these other ones? And, again, these are our opinions and mostly observations, but a few things that really popped out. Number one, these were more niche banks. So Silicon Valley Bank definitely catered to more venture capital, tech startups. And then when you look at some of the other banks like Signature Bank, as well as Silverlight Capital, they were more crypto focused, cryptocurrency industry. And so that was part of the dynamic, is they didn't have, if you look at concentration risk, because they were a little bit more niche banks, they had lack of a diverse deposit base. They had concentrated loan portfolios, and the vast number of deposits were not FDIC insured. And that's one of the big challenges. I mean, when you start looking at the fact that a venture capital company or a tech startup has a checking account where it's their operating capital, a lot of these businesses are spending millions of dollars a week. So most companies just felt comfortable having deposits on hand at these banks that were not FDIC insured. But this also led to the downturn because they didn't focus on risk management. These are the end depositors. They were hopefully just relying on the bank to do their job, and unfortunately, these banks did not. This concentration risk is where this started, and then this is items number 3 and 4 is really what tipped everything over. And we just covered this on the last chart, is the pace of interest rate moves really caught the banks, basically they were just off guard, right? They were not aware of, I want to say they were aware of what was happening, but they took these undue risks and unnecessary risks for their shareholders.
Well, and I think also kind of, right, got into this issue where, in the bank, for these corporations, when they hold these assets in their investment portfolio, they don't have to claim the loss to investors until they actually sell something, right? So unrealized losses just sit on the balance sheet and there's no kind of accounting for that. So as soon as big losses hit, the banks couldn't just immediately unwind their position because the loss would have popped up, right? And so, I think Silicon Valley Bank, there's been a lot written on this, but I think some of the same factors have played out at these others, where now they're sitting on a lost portfolio and they don't really know what to do with it, right? Because as soon as they sell, now they have to claim that loss, and the kind of cycle begins. And so I think that was also a major concern for some of the banks, was just, what do we do now that these losses are here and fearing runs on the banks or issues with deposits, et cetera. Those things all played themselves out in a not so good way at Silicon Valley Bank, but as your chart showed earlier, that's still an issue that exists for many banks right now. It's just those losses sitting on their balance sheets.
Yeah, for sure. So this is, it's not unique to just the banks that are in the headlines today. There's definitely going to be some pain on the balance sheets of other banks. And so we'll see how this unfolds. But the last part was really what caused this all to happen today, or that happened now, was we really had this social media mania where we had basically hysteria induced bank run. So this whole idea of a run on the bank. So I think something like $50 billion of deposits got withdrawn from Silicon Valley Bank because that whole community is so tight knit. They just decided to call each other, let each other know, posting on social media. And then people just kept taking withdrawal after withdrawal after withdrawal. And then eventually they didn't have enough cash on hand to meet the withdrawals. And so that was a traditional run on the bank. And that started happening in other areas, which is why the FDIC stepped in to stop that. And so the government came in and provided, at the end of the day, they provided a bailout. But the one thing you have to remember is I think we have to distinguish between who did they bail out. First and foremost, they bailed out the depositors because we had lots of people who had deposits, companies that had deposits on with these banks that were in excess of the FDIC threshold or were in accounts where they had no additional FDIC protection. So that was number one. They wanted to bail out the depositors for two reasons, I believe, and this is definitely my opinion, but two reasons. Number one is that they these depositors, a lot of them being companies, they are still running a business. And so they didn't want to have this ripple effect where you start freezing up capital for all of these operating businesses and they can't make payroll, they can't pay their bills. And then it has this spiral effect in the economy because people can't pay their bills. That's number one. Number two, they didn't want to have this ripple to other banks where people were getting nervous about having their capital tied up. And then this would have rippled down to multiple regional banks. Which would have then just caused a much bigger disruption in the economy. And so I think that's why they stopped it. What I'm seeing all over, whether you read the Wall Street Journal, headlines all over, news outlets, is that they're really calling this, a bailout for the banks. You can see the bullet point I have on here, Silicon Valley Bank and Signature Bank, their stock price went to zero. They stopped trading. It's halted. So that means if you're a stock owner, you are wiped out. So they did not bail out the stockholders. The bondholders, we're not sure if they're going to be made whole or not. It's not likely, but just to be clear on this, the depositors were the ones who really got bailed out. And in my estimation, I think that was a good and necessary thing. The challenge becomes, how do they repair this on a go-forward basis? Because we all know you have FDIC protection for a reason. It's at $250,000 for a reason. So people did not. I guess people didn't exercise any sort of financial discretion or they weren't even concerned. We had a few clients that had $2, $3, $4 million in their business checking accounts at some of these banks, and just a few of them. And this was their operating capital. They didn't even think that I had to spread this amongst a bunch of different banks. And so that probably will create some moral hazard later for the banking system. But I think they did the right thing. How we kind of learned from this. I hate seeing more regulations in place. But the reality is we're probably going to see some more out of this because anytime the government steps in, that usually is the result. So the next thing on here is the government reaction. So what did they do? So when the FDIC stepped in, they basically created this new facility. It's called the Bank Term Lending Program. And so it basically provided an emergency facility to provide loans up to 12 months. And then banks can use their bonds. So the bonds that Chris and I spoke about in terms of the bonds that they were designed to hold till maturity, these are on their balance sheets. They can use these as collateral so they can avoid selling them. So they don't have to worry about getting a traditional run on the bank again. They can actually avoid selling these bonds, which will help to shore up the health of the existing banks, those that are still remaining, all the regional banks now. And then a big part of this is restoring confidence in the banking system. I do think the Fed's action was not to try to pick winners and losers in this. I think that they started looking, okay, if we don't do something now, this is going to ripple down the economy to multiple regional banks and then through the economy and make it and have a much larger impact. So they did what they could to really stop the bleeding. So that's where we are today. I don't think we're out of the wood. I don't think we're anyone's really raising the all clear flag or ringing the bell that everything is behind us. I do think there's going to be some more challenges. What that looks like, it's going to take some time. And so I think that as we start going in and we'll wrap up our conversation today on what you should do, I think exercising caution is really important and making sure you're diversified. And that's a big part of how we help our clients manage money is just make sure you're being prudent and diversified. And we'll jump into that. But as we transition off of what we just went through in terms of what the government involvement has been, I want to transition this back to Chris, where he's going to cover some of the FDIC basics.
Yeah, and as we just make this transition, I mean, I'm the lucky guy, the compliance guy, put my compliance hat on and have to talk about fun things like FDIC insurance. But a time like this, it does pay to come back to the basics and the fundamentals of investing. So I think hopefully this is a good reminder for everyone on the call. I will say, if you have questions on any of the things that we're covering, feel free to put those into the Zoom. We can address them as we go, or we'll definitely tackle them at the end. So coming out of that, I know we ran through things pretty quickly, but if some questions pop up, please feel free to ask through Zoom. So, just I guess at a really high level, and most of us know this, but the FDIC is an insurance system set up by the federal government to insure depositors of banks in the event that we're talking about right now, right? a bank fails and you have your cash at that bank, can you go and recoup any of the cash that you had sitting there? And so the rule of thumb is that individual investors are protected up to $250,000, and couples or joint account holders are protected up to $500,000. And there's a lot more nuance to that. And initially, I put it together about 20 slides to walk you through examples, and we figured we'd spare you the headache of that. But I will go through an example a little bit later just to show you how some of the nuances do play themselves out. So it's not as cut and dry as just you have $250,000 at the bank and you're insured, and you have $250,000 and $1, and that $1 isn't insured. There's a little more nuance there, and we will touch on that briefly as well. And it's also important to note, again, I think we have a slide on this, but this insurance covers essentially cash positions, CDs, deposits at banks. It doesn't cover mutual funds. It does not cover your investment accounts. And so when you start thinking about the limits of your account or how much you have in your accounts, know that this is just focused on the cash portion of any account that you have at any given bank, any FDIC member bank. So here's a breakdown of that. You can see on the left-hand side what the FDIC covers: checking, savings accounts, CDs, et cetera, direct money markets at the bank. What it doesn't cover, like we mentioned, are stocks and bonds. So cash positions in these funds aren't covered. You might have like a money market mutual fund. That is not covered by FDIC insurance. That is invested in a mutual fund. So you can just see, I think that's an important distinction for us to make and understand, is we're dealing with two separate things when we start looking at our account balances, and we need to be focused for FDIC insurance purposes only on the cash balances. And question came up, does it cover CDs? Yes, it does cover CDs. So that is included in the insurance limit. Let's go to the next slide, John. So this is just an example. Again, I won't walk you through all the details, but it kind of shows you, I guess, let me make one other distinction. FDIC insurance is per depositor, per banking institution. So if you have two banking institutions and you have checking account at one with 250,000 and a checking account at the other with 250,000, both are FDIC insured, assuming they're FDIC insured banks, both are FDIC insured up to those limits. So you'd actually have $500,000 of coverage. But in this case, let's assume all these funds are at one bank. Well, if a husband has a single account open in his name, a wife has a single account open in her name, both of those can be insured up to the $250,000 limit. Husband and wife have a joint account. That is considered a separate account type under FDIC insurance. And so that account as well can be insured up to $500,000. POD stands for pass on death. And so TOD is another acronym we use for that. But you could have a TOD account, those have that are owned separately. You actually have a revocable trust that is owned separately and has different rules around the number of beneficiaries. So again, there's lots of rules that can go into this. And so I don't want you coming out of this presentation thinking, oh, I have more than 250,000, I'm not FDIC insured, or I have less than it, I'm totally fine. Well, in that case, you would be. But there are a variety of ways that these things can be laddered out in order to make sure that to see that your coverage is actually far more expansive. I do see some questions just came in. So does the insurance apply to federal credit unions? So there is on the FDIC website, you can just Google this, FDIC insured bank lookup, something like that. And you can go and you can just look at the name of the institution that you are banking with, and it'll tell you if it's an FDIC member bank. So that's a very easy way to look at it. Most banks also kind of at the bottom in the footer of their bank website will say FDIC member. And so that's another way to kind of confirm that your bank is an FDIC member. How would you go about creating a layer of protection of funds invested in stocks and mutual funds? So we'll get to that in a moment, because there's another layer of coverage called SIPC. And so we'll touch on that in just a second. And then touch on some of the other layers of that. John will get into it in a little bit. So all good questions. I think before we transition to this, John, I will have you address that slide. I just want to say that just because you can go get FDIC insurance and spread across this risk across different account types doesn't mean you should, right? So for instance, let's say you've done estate planning and you've hired an attorney and you've paid that cost and you've set up a revocable trust for your family and you've done all that work. Well, you might not want to take assets out of the name of your trust and move them into an individual account, because now you subject them to probate and things of that nature. And so banks have actually set up lots of programs to assist with this because it's not convenient, especially if you start having millions of dollars in deposits, which some do, right? It's not convenient for you to have to go manage all this yourself. And so, John, maybe we could flip to the next slide and you can maybe touch on some of the different ways that banks actually have programs that are trying to assist with some of these things.
Yeah, so most banks have these enhanced savings programs, which actually will provide FDIC protection and up to these larger limit amounts. I've seen them at 30 million, 50 million, 125 million. And so what they do is they create this essentially partnerships with banks all over the country to offer this enhanced program through the FDIC. And so usually interest rates are a little bit lower on that to get that extra layer of protection. But for those people who have higher deposits, who are going to keep that amount, these higher elevated balances with banks, they should be looking at this for an option because that's the only way to for sure protect your assets. And then I know with the case with Raymond James, they'd have like a sweep account where they call it like a waterfall account where they could basically spread this this FDIC insurance over over 12, 15 banks to get these higher elevated amounts up to like 3 million. So every financial institution is a little bit different. And then obviously like bank CDs, that's a traditional FDIC protection that Chris spoke about. And then one thing is just to understand money market funds, because these are mutual funds, they don't have the FDIC insurance protection. So that is important to know. And then as we kind of navigate into this next slide, we'll talk about, well, what's in place for people who don't have FDIC protection and what is SIPC? What does that actually do for you as an investor?
Yeah, and I'll touch on this in a second. Someone did write a question: what's the protection for corporate or LLC accounts? Then the answer is 250,000. But as you can see, I mean, there is more nuance to it. Again, if we needed to look into the details, we could. I'd be happy to look at that in more specifics. There are some nuances that can apply, but really it is 250,000. And but again, that's why some of these programs exist. So you might have, for instance, I sit on a board of a nonprofit. We have an operating account at a bank. Our operating budget is beyond the $250,000 limit, but we are in a sweep program that actually has up to 125 million of coverage, right? So you can get around those rules. Again, don't over-engineer trying to manage to these rules. These rules are in place for a reason, and it's helpful to be aware of them. You don't want to be caught kind of off guard, but there's also programs that most of the banks run that allow you to increase your coverage without a whole lot of additional work. So let's just talk briefly about FDIC versus SIPC. So SIPC stands for Securities Investor Protection Corporation. It's technically a nonprofit. It's not a government entity. However, SIPC does not deal with deposits at banks. SIPC coverage is meant to be there in the event that the brokerage firm that you are working with fails. And so in that event, if securities go missing, so Lehman Brothers collapses and you are an investor, you held your investment accounts at Lehman Brothers, and some of those assets go missing, SIPC, meaning you can't find the shares that you had invested in, name your stock or bond, SIPC will insure up to 500,000. And so that is a larger limit. 250,000 is the cap on cash. So again, that's within the investment brokerage account. And the other thing to kind of note is, and we didn't go through a bunch of examples here, but SIPC coverage also has rules around what they call the capacity of the account. So if you have an account, like for instance, a retirement account and a taxable brokerage account, both of those carry SIPC coverage up to 500,000. And so there are distinctions and rules, and your advisor can help you work through those and figure out what existing coverage you may have at your particular institution. But it really is there. Again, it's not insuring the loss on any investments. It is insuring against essentially those shares going missing or some fraudulent activity occurring at a bank that fails or at a brokerage firm that fails. So that is the distinction between the two. And again, I think it's kind of important to just be aware of the fundamentals behind each of those insurance or protection programs.
And Chris, I know we don't have it noted here, but I do know that many large financial institutions have what they call excess SIPC coverage, and a lot of times, and I I don't want to overly generalize, but these numbers will be 20 million, 30 million, 50 million. So there is excess in place. And so just know that most accounts will be protected for a larger amount than that. Because I think the coverage costs of that excess SIPC is just not very much. And so most of the large financial institutions that everybody would know have that additional coverage. But that's something we can provide. So if you're curious about this and how your accounts are protected, we can definitely provide you some more follow-up information on that.
Right.
All right. Anything else to add on this, Chris? Are we good?
No, I think that's it. I mean, if you have questions, again, feel free to throw them in the Zoom. And I, could walk through a couple scenarios, but let's keep moving forward.
Okay. Sounds good. So, the big question that we've been getting is just like, there's been a lot of recession talk. We did a webinar last June that said we're in a recession and why it's a good thing. And I think most people didn't like my title of why it's a good thing. And the reality is, we've seen it. We've been in a pretty choppy market environment for the economy over the last 9 months. A lot of it has been because of the Federal Reserve raising rates. We've continued in 2023 with the economic choppiness. Some industries are still thriving, some are struggling. We think that's going to continue for the remainder of the year. We don't have a crystal ball. Obviously, we don't know what the future is going to hold. As you know, we're long-term investors. We're big believers of diversification. That's the appropriate way to manage your money over the long term. But the reality is we're going to see we're going to continue to see recessionary signs. The Federal Reserve is really pushing rates up to slow down inflation. And that's likely going to cause some slowdown. It's already been occurring. And so if you're concerned about that, which we all want to be aware of what's happening, like what actions can you take? And this is just a little bit of a reminder of getting back to the basics and the fundamentals and reminding like why you invest. And so real quickly, I want to walk through the asset allocation methodology that we follow. And so you can see, we have some charts on here, but just above where it says cash equivalents, it says allocation based on. So we're big believers that your asset allocation over time should be based on your cash flow needs. What are you going to need to spend money on? Because if you need to spend the money, then what happens? You got to take it out of the account. So if you're going to need to spend the money, we want to make sure we have it in highly liquid investments, usually that have lower volatility or lower investment risk versus high risk, right? We want to focus on that. So we base it on spending needs for the next 7 years. We look at the next 7 years as a critical period of time because we know historically economic environments, expansions, recessions, stock market, bull markets and bear markets, they tend to happen over these longer cycles. And we feel like 7 years is enough of a period of time to secure your spending needs. And so for those of you who are spending on a regular basis because you're retired, we have a lot more clarity there. For some of you who are still working, you might not need a lot of spending needs out of your account. But really, our financial planning process, which drives this asset allocation, is how much you need to spend over the next 7 years. And if you look on here, we have these three bar graphs. On the left-hand side, it's cash equivalents. So any money that you're going to be needing to spend in the next 2 years should be allocated in some sort of cash equivalent, which could be short-term bonds, money markets. Everyone's a little bit different, so I don't want to make this a uniform statement, but a cash equivalent type of investment that's not going to be subject to much volatility in the market. Then the next bucket of money is fixed income, right? Those are traditional bonds, things that are paying out income. They do have some volatility. We addressed that on the Treasury slide earlier, that there can be some years where you have losses, but they tend to be more moderate risk. And so we really look at making sure you stay disciplined to this. And so if any of your financial goals have changed given the circumstances in the economy, then clearly we want to evaluate the asset allocation to make sure it matches up. But we still have the same discipline that when we look at over a long period of time, we want to be using growth assets, which, technically the growth assets we look at are stock related or real estate related investments, whether they're in mutual funds, ETFs, or direct holdings. But that's really how we look at the asset allocation. We start there, and that's all from the planning perspective. Then the second part we go into is risk assessment. And it really comes down your tolerance for investment loss and volatility. Because a big part about being a good investor is you have to stay disciplined through times of uncertainty. And we're certainly going to be going through one now. And if this stuff is harder to stomach, we need to know as your financial advisory team, because we want to know what's happening. And if you are getting to a point of where you can't tolerate this volatility, we have to review your asset allocation. So remember, the asset allocation is driven on those two factors, your cash flow needs and your tolerance for the volatility. And that's one of the things that I know in all of our review meetings, we're constantly coming back to those issues, because those are things that are in your control. And a lot of that comes down to the behaviors around, again, how we spend money and how we react to a lot of the uncertainty that we're seeing in the economy.
Hey, John, I was going to ask real quick, I think this is a really clean model, especially when you're spending from your portfolio, right? Because it kind of shows you how to allocate. What about for someone who's currently working, right? They're currently working. So the spending need from their long-term savings is pretty much zero, but they still need to have a cushion. So what are your thoughts in terms of how people should be thinking about, gearing up for, that R word, the recession, right? If we're heading in that direction, how should people be considering how much in cash they should be holding versus how much they should continue to be putting into long-term investments?
Yeah. So, I mean, I think it does come back to looking at this chart we have, is that 0 to 2 years in terms of your spending needs is a good target for cash or cash equivalents. So that, if you were laid off, how much cash run rate would you have? So when we look at the cash component for someone who is still working, where retirement's not, on the horizon, then you want to have 6 months for sure in cash, which would handle 6 months of your spending needs in cash. Whether that way it's fully liquid and can basically make sure your family's okay. But I do love the option, or really the recommendation around keeping a little bit more, trying to keep 2 years of cash, or at least having cash accessible. That could be through a business line of credit, through a personal line of credit. So at least having the cash available, or some sort of cash alternative if you had to have like any sort of like emergency borrowing scenario. The other thing too is we've been having a lot of clients been adding money through this, and we're constant believers of like dollar cost averaging, continuing to add to the markets. And so that's really been our MO, because we think we're going to have some ups and downs here over the next 6 to 9 months and maybe longer, is being very disciplined about dollar cost averaging, is like making sure we're a consistent investor even through all this noise. But that's a big part, is if you're still working, again, you don't have that immediate cash flow needs, but you also might want to try to anticipate what's out there. Like if part of your financial goal is I want to buy a house, and you look at it, maybe a recession is going to give me an opportunity to buy a house at a better price. Well, you're going to build more cash, right? So now you still can have that mentality of what's this money for? It might not be supplementing your income, but it might be, hey, there's some assets that I want to accumulate or buy during this period of time, and it should go into cash. Because I think the danger is when it's short-term money, like if you want to buy a home in 3 years, you put it in the market. If the stock market goes down, or your investment goes down, and now you're ready to go buy the home, you're having to sell something at a bad time. That's the whole reason why it's important to have this cash discipline. And the good news is, we've seen interest rates come up where, cash and money market accounts are fairly attractive. And so every bank is, banks haven't been great, but some of the cash rates have been pretty attractive.
Okay, great. Thanks for chiming in on that.
Yeah, that's a great question, because we get that a lot. And there's no perfect answer, but having some cash on the sideline definitely helps you sleep at night. And that's a big part of like planning properly, is like making sure that you're providing some of that financial peace of mind. And a big part of that is when you have some reserves, it definitely takes some of the stress out.
Yeah.
Okay. So there's a lot going on here. This is a consumer confidence chart, or a consumer sentiment chart. So University of Michigan puts out data on consumer sentiment. Basically, they're trying to measure, are consumers pessimistic? Are they optimistic? Are they neutral? And if you look at the data here, they score this basically between, on the low end, 40 up to about 120. You can see there's a dotted line across the middle that says the average consumer sentiment is around 85. So we could argue that if you're above 85, then you're generally more optimistic than normal. And if you're below 85, you're more pessimistic than normal. And so what's really fascinating about this, and the whole point of this, is that when consumer sentiment is really high, that's at the peak, that's at these peak levels, that's when we feel the best. And when consumer sentiment is really low, that's when we feel the worst, right? That's just the fear and greed component of the psychology of us as human beings. One of the amazing stats that we're seeing here in the top left that shows, Well, when we have these peaks or these troughs, how does the market actually perform 12 months later, right? So when we look at these levels, nobody can predict the future, but if we look at the last, this is a 50-year chart. There's a lot of data points here. Based on a peak in sentiment, which means optimism, how did the market do? And you can see the 8 peaks that we've seen over the last 50 years, the stock market on a go-forward basis as measured by the S&P 500 averaged 4%, 4.1% per year. At the 8 sentiment troughs, which means at the bottom of this chart, that the S&P 500 on a go-forward basis averaged 24.9% on a go-forward basis. And so we don't know what the future is going to hold. We know past performance is not going to be indicative of future result. However, when we look at some of the data points, this does suggest when sentiment is low, which is an environment we're in. If you look at the very far right part of the chart, as of the end of last year, the University of Michigan sentiment was down around 60. That's at these lower levels where it would actually show us historically that returns on a go-forward basis would be stronger than when optimism is high. And so the whole lesson here is that as investors, when things don't feel great, we have a tendency to not invest, and really the opposite should be the case. When you feel the most like pessimistic is actually historically should be the time you want to invest, and vice versa. So I don't know if you have anything to add on that onto that, Chris, or if that made sense.
No, and I think the next slide you touch on is just an interesting aspect and kind of will tie these two ideas together.
Yeah, so we know that what tends to drive investments up over time. I mean, clearly investments have to be more profitable over time. Companies have to earn more money. But what tends to drive assets higher is when there are more investors, right? When markets go up because there's more buyers than sellers. When there's more sellers than buyers, markets go down. And so what's interesting is when you look at cash on the sideline, cash usually isn't designed, and this is measured by money market funds, cash is usually not designed to stay in cash. It's there temporarily. And if we look back, this chart goes back to 1996. So we're looking at almost not quite a 30-year, about a little bit over about a 26-year period. And you can see these different different peaks of cash. We saw one in January of 2003. We saw one in January of 2009. And then you can see we have a couple recent peaks here. One was basically right as COVID was getting started in May of 20. And then January of 2023, what we just lived through. And what this basically shows us is that when we have these historic peak in money market funds, how does the stock market actually perform on a go-forward basis? And so you can see on the right-hand side, this measures 3-year U.S. stock market performance following a peak in money market assets. And so the first one represents that 2003 peak. The market averaged 16% per year. The next peak, which was in 2009, averaged 19.2%. And then the COVID peak, we actually aren't through our full 3-year cycle, but it's averaged about 13.3%. So this is just designed to show you that when we deal with these money market peak in assets, this tends to give us higher rates of return than the historical average. And if you look on there, there's a dotted line that goes across that says 10.2% is the US stock average since 1926. So periods of excess cash usually means the future will be bright. And that goes against a lot of the pessimism that we're seeing. And so be cautious about changing your investment strategy or philosophy just based on the current economic headlines. Because we remember coming out of COVID, there was a lot of uncertainty and the markets did really well coming out of that. And so just be mindful of this. This is just trying to really cement the fact that we don't know what the future is going to hold. And all this pessimism out there might actually be a healthy thing for the economy and the markets on a go-forward basis.
Well, I think it's funny because sometimes we'll sit in a room with a client and it's like, well, we'll just buy it, or even like in the classroom when I was studying this stuff, whenever 15 years ago, it's like I'm just going to buy when the market's down there, and then I'm going to sell it when it's up there, and it's like, oh, that's easy. And obviously everyone on this call and everyone knows that it doesn't exactly work that way. And part of the reason why, and what's so interesting, is that consumer sentiment, right? It's like how I'm feeling right now doesn't make me feel very confident in putting my money to work anywhere. I want more confidence and more assurances. And so, I think that comes back to the liquidity stack that you talked about, right? It's like, if if you've got cash and you know that you have that comfort cushion, and you've built up some additional, more conservative investments with your assets that are there for growth purposes, like you can take risk, and it's not irresponsible risk at that point, right? But I think it's really easy to look back and make those, oh, I'm going to buy because now's a good time because the consumer sentiment is down. And it's, well, it's easy to say that, but consumer sentiment's down because we don't feel very good right now.
Yeah.
know?
And the markets reflect that, right? And that is a question we get a lot is, okay, I have cash, what should I do with it? And we always step back and ask the question, well, what's the money for? And if the money is for something needed in the next 1, 2, 3 years, it's like, keep it conservative. It's not worth taking risk because there's too much unpredictability of the results. If you give me 10 years, then we can have confidence that we can invest in some longer term assets. And so that's exactly right. I mean, that's where it really is counterintuitive. And that's what makes investing so hard, is you have to have that discipline, even when it's uncomfortable. And we're going through an uncomfortable year. Last year was an uncomfortable year. I wish I could paint a rosier picture that it's going to get comfortable this year. I think it's still going to be a lot of ups and downs, but that's where good, strong investors with discipline will prevail. And just by making those good decisions and sticking to their financial goals and their financial plan, not trying to guess what the future is going to have or hold for us, because we have opinions on what's going to happen, but nobody has a crystal ball. So, it's important not to try to guess. It's important to make decisions based on your goals, your time horizon, your risk tolerance, and things like that.
Right.
Okay. So some action key takeaways as we wrap up. And, these are some key fundamental things. When we have periods of uncertainty, it's always best to get back to the basics. So we need to review and update your asset allocation based on your financial needs. If your financial needs have changed because of what's going on, that's normal. Sometimes things just change. Maybe you don't want to work anymore, whatever. Something in your life might be changing. If that changes, your asset allocation probably needs to be reviewed and updated. The next item, cash discipline. We talked about this earlier. At least 2 years of spending needs having cash. That'll help you weather a rocky environment, especially if you lose your job. Having some more cash reserves will help you sleep at night. The third item is assess portfolio risk and ensure that you can weather the volatility. That's the hardest one, right? We're all okay with risk when things are going up. It's just when things go down that we're like, oh, I didn't want as much risk. But the reality is that risk tolerance should be tied to your long-term financial goals. And if you're feeling like you're at a point of like, I can't tolerate this, then we got to relook at your financial goals, because most of the time when we are assessing the portfolio risk, if we lower the risk, we're going to also lower the return, which is okay. But if we're going to do that, that might have an impact on your long-term financial goals. So again, coming back to those areas where we have to look at it. And then last one, build confidence, update your financial plan. I know these all tie back to update your financial plan, but a big part of being able to weather a challenging economic time is by having confidence in your plan. And so again, get back to the basics. I know as we've been doing annual reviews for clients, we've been spending the majority of time reviewing the financial plan, making sure the financial plan is healthy. So we're here to help. Hopefully this was helpful. If you have any more feedback or questions when it comes to these issues, we're here to help. We want to make sure. Oh, looks like we got one here, Chris. So it's actually good timing, because we're gonna go into a little bit of Q&A before we jump into this. So if you have more questions to add, we do have a little bit more time. But I do just want to remind you that if we have any prospective clients on the call and they would like a 30-minute complimentary consultation, we'd be happy to connect you with one of our wealth advisors. Go ahead and you can scan the QR code and to book an appointment. And then also, as you know, or you may or may not know, we postponed our retirement planning webinar, which was supposed to be today, for April 18th. And we're going to cover the Secure Act 2.0. Basically, that's the new legislation, and there's a lot of new rules around retirement planning. So that'll be our next webinar on April 18th. And
some of the conventional wisdom around the Secure Act, right? Like what we know about funding IRAs and Roth IRAs and all those things, there's been some significant changes. So that'll be an interesting conversation.
Sure.
Question that came in had to do with the president's recent veto vote. I don't know if you want to touch on that, John, or want to steer clear of any politics there, but any comments you have there?
Was it on, I think it was the veto on the ESG.
Believe so, right? He vetoed the bill passed by Congress, or at least
that's been a debated issue for at least the last 4 or 5 years, where trying to get allowing retirement plan fiduciaries to use ESG, the environmental, social, and governance, I think that's what that stands for, screens to make portfolio management decisions. And that was, they're trying to overturn the law to basically remove that. So basically not allowing ESG to be part of the criteria. I don't know. I mean, it's not really surprising that Biden vetoed it. I know we haven't had a lot of there's been no vetoing recently because we've had a Democrat-controlled House and Senate. So, I mean, I generally, I'm not a big supporter of, and again, this is my personal opinion. This is not a Vance Wealth opinion. I'm not a big supporter of having those ESG screens. I think they're somewhat artificial. I think that you're starting to see some pushbacks, like BlackRock, as an example, has been a proponent of it. Vanguard just came out against it. So I feel like just having, allowing investment fiduciaries to do their job based on some prudent decisions and not put in these artificial screens, which, can be manipulated. So again, I'm not super happy about it, but it's not a surprise that veto occurred.
Yeah. And there was another question that came through just on a similar vein around Vance Wealth's position on ESG investing. And I think John just spoke to that. I mean, we don't have any dedicated ESG portfolios, so that's not something that we're deploying specifically for clients. I think, John, I've heard you say many times, if you want to do good in the world, like a great way to do that is like invest in the organizations and the causes that you're really passionate about. I don't know if you want to elaborate at all any further on that, but from a Vance Wealth perspective, it's kind of a factor we don't look at.
Yeah, and so there's two parts to that. So yeah, that has always been my take, is if you look long term, I think just broad market-based returns have been a little bit stronger than ESG, run portfolios, and that's certainly not the case that's not in every case, but that's been kind of over the broad markets. And so our attitude is, I'd rather have you take excess returns if you're getting them and give more, donate more to charity, make an impact on what's important to you. That's kind of just my personal feeling on that. But we also have clients where the ESG issues are really important to them. Like, that's a driving component of how they look at the world. And so we do have those options. And so if that's an important part and something you want us to consider, we know what that landscape looks like. We know the managers that do that effectively. And so that is something we've done as clients have asked us, but it's not something that drives or shapes our investment process for our entire firm.
Great.
Did we get another question?
Not a question, just kind of a comment. So if we can hang around, but if there's any other questions, but we appreciate everyone's time on the call today, and I'm glad to shed a little bit more facts. Oh, here we go. Another question. Are there any tax benefits for ESG?
Not that I know of. I mean, I think probably at the company level, there's obviously tax benefits, when a company decides to take an environmental position, or to have recycling or solar. There's definitely tax benefits at the company level, but as far as I know, there's no specific tax benefits to a specific fund or to a specific stock. So I don't know, Chris, if you have any.
Yeah, no, I think that's right. I mean, at the end of the day, it's still unrealized gains and losses, realizing gains and losses in taxable portfolios, things of that nature. The structure of these companies, I mean, these are publicly traded companies. So it's not like you're, investing in a 501c3 and there's some tax benefit to that, right? These are large publicly owned companies. And so it's not, to my knowledge as well, there's no inherent, tax advantage to investing in an ESG strategy. There might be some ways that certain strategies are run that make them more tax, advantaged than others, but nothing specific to the nature of the investment strategy itself. Yeah,
those are great questions. Thank you, Chris. I enjoyed hosting this with you. I wish we had a more fun topic, but I think it's definitely one that clients need to know about. Yeah, because I know there's been some sleepless nights with just having these conversations with people about just making sure their money is protected, and we're here to help. So, as things unfold in your life, if there's areas that, of concern, if there are things we can do just even to hold your hand and to walk you through, and explain this. Again, that's why we did this webinar, but we want to be that trusted partner to guide you through these times. So thank you very much. Look forward to seeing you all next month. Thanks, Chris.
Thanks, everyone. Have a good day.